Hi everyone, it's Jim Ayler here from JIM2U Live. Thanks those for watching, for joining the JIM2U Live podcast tonight, and for those listening, the JIM2U Live podcast. Anyways, we have a very special guest with us tonight. We got Jon Duplessis from
right.
Investors Group. And John's going to be giving his top tips on how to invest for the future, and not only invest for the future, but also how to protect that future as well. And I just want to be very clear before we open up, John, just that, this is not a cookie cutter video or solution, because when it comes to investing for your future, everybody is unique. And the investment options are as unique as the individual, based off, job and budget, cash flow, what's important to them from a tax standpoint. So what we go over tonight is really just touching the surface of what people should be doing, and some general stuff that does apply to maybe 85% of the market out there, or 85% of the public out there, right? But keep that in mind, that if you do need help, this is a great guy, and you should be seeking, professional advice, obviously, which is what John's going to give us here tonight as well. So first off, John, thanks for joining us here.
I appreciate the invite. It's great.
Oh, it's lovely to have you. I don't know if you remember, but I remember playing ball hockey way back in the West Side days.
I loved it.
The early days and stuff.
I keep doing it a little bit, but I realize I'm getting a little bit older, so it's not as easy anymore on the body.
Yeah, no, my knees can't take it. So it's great to have you on here now, many years later. So it's excellent. And you're with Investors Group, so why not just first off tell us a little bit about yourself and maybe what got you into the financial field to begin with?
Yeah, definitely. You know what? I went to university. I did a major in mathematics, and I actually originally went to be a meteorologist. If you can imagine, I love the weather.
Really?
I have a passion for the weather, right? But you know what? After exploring that career, and I realized the real job I wanted to do, I had to leave the country and go some other places, and I just didn't want to do that. My family was here, so I went back to taking my investment courses and my insurance courses, financial planning courses, and I went to IG Wealth Management just because of the products and services they had to offer, and I thought it would be a really good fit for me and my clients. So.
Right, excellent. So, John, you're going to give us some advice tonight on, you got quite a bit here actually. Hopefully we can fit this within 30 minutes, but it's great advice. I was looking it over, and I think a lot of people out there can benefit from this. And if you do have any questions, please feel free to leave comments, or make some comments or ask your question. We can definitely answer them as we go along. But with that said, so we're going to talk about investments, what investment vehicles you should be using based off where you're at. John, you're more the expert on that, so I won't say anything on that. And then we're also going to touch base on how to also protect that as well, because a lot of people, and especially now, I think with COVID-19. Now is probably more a more important time than ever to discuss it, because I think a lot of people realize that, wow, people may have lost their jobs, stuff like that, and it's very hard, because not a lot of people out there will have a nest egg of, say, 6 months of savings or 100%. Something like that, right? So I'm glad to have you here now, because I think now more than ever is a great time to be discussing this. And
couldn't agree with you
make
more.
Sure that people are set up for the future.
There's just so much uncertainty in the market. You turn on the television, and it's doomsday every day. They focus on negativity, but really, you turn it on. COVID cases are spreading, and that typically drives the financial markets down. So you get your statement, and it might not look so good, right? So you're right, and that's where advice comes in.
Right. Yes, for sure. So I'm going to let you jump into kind of your agenda and what you want to talk about first.
Yeah, you know what? There's a few things I want to talk about. I want to talk about just the main types of investment accounts. So an RRSP, tax-free savings accounts, non-registered accounts. A lot of people aren't familiar with that, so I wanted to bring that up. I want to talk to you a little bit about maybe what you can put inside of those accounts. I know a lot of people know or heard of bonds or GICs or stocks. I want to talk to you a little bit about that.
Okay.
I want to talk to you a little bit about investing on your own. So you can invest on your own, or you can go and seek advice and pay for that.
Right.
And sometimes it's better, if you're extremely knowledgeable, to maybe do it yourself and save that approximately, say, 1%. But for the majority of people, they don't have the time or the knowledge. It's worth paying that about 1% to get that advice.
Yep.
And I want to talk to you a little bit about, and it's a topic I talk about every day, mortgage insurance, term insurance, and permanent insurance. And they're all so different.
Right.
But no one seems, a lot of people just don't know the difference between them. So I wanted to really go over those things today.
Okay. Excellent.
Yeah.
Wonderful. Well, let's just jump right into that then. So what are the main types of investments out there, or the investment vehicles, to plan for your future?
Yeah, so besides, having maybe a pension account at work or a group RSP, you can open an individual RSP account. And I think we're all familiar with the term. You can open up an individual tax-free savings account, which has, it's still relatively new for a lot of the population, right? They've been around for 11 years or so now. Okay. But it's still, it's new in the financial world. And then there's something called a non-registered account, which is not an RSP or a tax-free savings account. And a lot of people just don't know that exists.
Right.
Like if you don't want to put money in an RSP and you don't want to put into a tax-free, or you can't because maybe the two are full, where else do you put it? Right? So realistically, an RSP is a savings vehicle. When I say vehicle, it's a place that you can put money that will grow tax deferred. All that means is when your money grows, you don't have to pay taxes on the growth until you take it out.
Right.
Now, the advantage of putting money into an RSP is you get a tax break.
Yes. Yeah.
Right? And in the higher income level you are, the bigger that tax break is. So an RSP usually for people that make, let's say 100 grand or even 60 grand and above, not necessarily lower income earners. RSPs are very beneficial because you're saving quite a bit of money up front on income taxes.
Right.
But you just have to be aware that when you go to take that money out, hopefully in retirement, that's, the ultimate retirement savings vehicle is ultimately for retirement, you're going to have to pay taxes on that money. So, you have to kind of balance it out. Is it better for me to save money today on my income taxes and pay money at the end? Right. So that's where maybe advice would come in, and you can run future projections.
So what's one or two pros of an RSP then?
Yeah, definitely. So if you contribute to it, you're going to get a tax break on your income taxes. Simple as that. So you're going to pay less income taxes this year. So that's one pro. The other big pro is that money will grow if invested properly, and you don't need to pay taxes on that growth until you withdraw the money.
Until you withdraw the money. Okay. And if there was one con on an RSP, what would you say that?
If you take money out, you have to pay taxes.
Okay.
That's really it. And there's a limit.
Yeah. Now, in terms of age, let's discuss that real quick, because the importance of compounding. I mean, I'm always trying to, I like to try to explain this to my children and stuff like that because they're young, But who wants to save at a young age?
No one does. You want to blow
exactly,
it,
right?
Yeah, of course.
But in terms of, for middle age and stuff like that, it's great because they have vehicles that they can utilize at work as well that are doing, savings programs through an RSP or a pension or stuff like that. And someone that may be young working at a minimum wage job that doesn't have that ability, what's the importance for them to still maybe see somebody and do $20 a month? It seems small now.
Yeah.
But if you're
they got something going for them.
18 or 20, can you talk about maybe the importance of compounding?
Yeah, absolutely. Right. So you're right. What they have going for them is time.
Yeah.
Right? Time is key, isn't it?
Oh, yes, absolutely. When
right?
It comes to money, yes.
And I know if somebody put $2,000 away, now I know for a 20-year-old, $2,000 might be a lot of money, but I know if someone put $2,000 away from age 20 to 30 and let it grow until age 65, so literally they put $2,000 away, age 20, 21, 22, 23, 24, all the way to age 30. At that time, just stop for some reason and then let it grow until age 65. And if someone started at 30 saving that same way but saved all the way to 65, the money is about the same.
Yeah.
It's unbelievable, right? And there's something I liked called the Rule of 72, and you may have never heard of it.
No, I haven't.
But I like to talk to people about it because it makes sense to them. So, and it's simple math. So 6 times 2 is 72, right? 3 times 24 is 72. 12 times 6 is 72. Why am I saying this? Well, if you make 6% rate of return on your investments, it will take 12 years to double your money.
Okay.
So if you made 8% rate of return, it takes 9 years to double your money.
Gotcha. So
let's just say 7.2 because it makes the math easy. Every 10 years, approximately, your money's going to double.
Right.
So if you're 20 and you make 7.2% rate of return, at 30, your money doubled. So your $100 became 200.
Yep.
Then at 30, your 200 became 400 at age 40.
Right.
And then 400 became 800 at age 50. And then 800 became 1600 at age 60. So that first $100 is now $1,600, and you only put in $100.
Right.
So that's compounding, right? So if you start 10 years later, you're going to have half the amount of money. That's basically the way to look at it.
Yep. No, that's great advice. So, you know, for anyone that is young out there, listen, if you can afford $20, do it. It's well worth it. It's money well spent. I mean, in my opinion, it's better than putting it at the bars, but
I'm sure we've all done that.
So we talked about RSPs. So now you got here tax-free. So
yes, so tax-free is another savings vehicle, and I love it. It's so versatile. Tax-free savings accounts, I really, I guess I'm tossed because it can be a great short-term savings vehicle, but it can be a great long-term savings vehicle. What's great about tax-free savings accounts, you can put money in, take money out, no penalty.
Yep.
Right? And the great thing is, if you did that with an RSP, you put money in and get a tax break. If you take it out, there's a penalty. But the thing is, with an RSP, there's only a set limit. Tax-free, there's a set limit, but if you use it and take it out, you get the limit back. And a lot of people don't know that either.
Gotcha.
Right? But I really like tax-free savings accounts as a long-term investment vehicle as well, because you put money in, it grows, you take it out in retirement, and it's tax-free.
Right.
And it's a great way to control your tax bracket in retirement.
Yeah, so it can be great long term, short term for sure.
Yep.
Because you're not getting the taxation when you take it out. So you know, for a down payment for a house or something along those lines.
Absolutely.
Now you made mention though, and I just want to clarify this for a lot of listeners or viewers that may not understand this, but when you say limit, so the government allows you to put in so much per year each year, and if you put in that max amount each year for 5 years. The following year, on the 6th year, if you were to take $5,000 out, then you have your limit plus the additional $5,000. That's essentially
that's
saying, right?
essentially it. Yeah, let's say the limit today is $59,500. Yeah. Right. So let's say I've never opened a tax-free savings account before, and I put $59,500 in, and then next year I withdrew it. Right. The following year, I get my $59,500 limit back that I can put back in. Where an RSP does not work that way.
Right. You got your limit and your.
So where a tax-free savings account vehicle really comes into play is I'm going to call it a mistake that a lot of people make is putting too much money into a registered vehicle, such as their pension or RSP. And the only reason, that's a good problem. I have a lot of money when I retire. Great, that's a good problem. But they're in a very high tax bracket.
Right.
Where it may have been more beneficial to not put money into RSPs today. Don't get that necessarily your tax benefit today, but you're going to pay less taxes in retirement. So I'm not saying it is beneficial. It's per individual, and you would have to project that out over time, and there's ways, there's software to do that. Okay. But a tax-free savings vehicle is not just a bank account. It's really a very high-quality investment vehicle.
And that's important to know too, right? Because you know, as I oversimplified it. I mean, I can put money into a savings account for let's say a down payment for a mortgage. Yep. I can do a TFSA as well, but to your point, a TFSA is really more meant for a midterm, a longer term goal as well, not so much as a short term.
That's what in terms of that was really what it was designed for. You're 100%. And unfortunately, a lot of people think it's a savings account, like a bank account, and it can be used that way. It's just not the ideal way to utilize it. And later on, we'll talk about what can be put inside your tax-free savings account to maybe make you more than 1%.
Yep. Okay. So we discussed our RRSPs.
Yep.
Tax-free savings account, and now you have the non-registered.
Yeah.
So what's that about?
Well, for especially business owners, self-employed people, even commission-based sales, they have some tax deductions in their life, and really they're trying to keep their taxable income down. So in many cases, RSPs are beneficial, but if they're already in a low taxable income bracket, they don't want to invest in RSPs. Right. And maybe their tax-free savings account's full, because the limit's only $59. It's only less than $70,000, right? 69. It's actually 69,500 is what the limit is. But where else do I put the money? If I don't want to put it in an RSP, my tax rate is full, where do I do it? Well, there's something called a non-registered investment account. Okay. And really the ultimate difference between an RSP tax-free savings account and a non-registered account is how they are taxed. Okay. As we know, there's a tax benefit to put money into an RSP, but you have to pay taxes when you take it out. Right. There's no tax advantage of putting money into a tax-free, but you don't pay taxes when you take it out. Okay. The way a non-registered account works is you put money in, you grow it, and you pay taxes. Well, it depends how you invest it. It actually gets a little more complicated. But if you invest it in something that's going to grow equities, and we'll get to what equities are here shortly. You pay taxes on half of your gains, not the full gains.
Right.
So that's important to know, because we're an RSP. You take $100 out, you're taxed on the full 100. Well, on a non-registered account, if you pull 100 out, you're not taxed on the principal you put in, only some of your gains. Okay. So that's important to understand. So a non-registered account is a very important vehicle to understand, a very important investment vehicle, especially if you're a business owner. You might have a corporate bank account, and I know a lot of corporate bank business owners that are incorporated. They have a large amount of money in their corporation, and they just don't know what to do with it. They don't know that you can necessarily open up a corporate non-registered investment account and invest that money. You don't have to do it aggressively. You can do it quite conservatively, but they're going to get more than maybe the 0.5% interest rate they're getting in their bank account, right? So yeah, so a non-registered account is just another vehicle. Usually, once your tax-free savings account's full, and if your RSP is full, or you don't want to put into an RSP, then you want to look at a non-registered account.
Okay.
Yeah.
So is there more or less risk with one over the other, or is that kind of what you're going to get into next in terms of what type of investments you can put into?
That's exactly it. They're all, you know what? The risk is not the account. The risk isn't an RSP or a tax-free or non-registered. They can be risky or it can be extremely conservative. It depends what you put inside them.
Right.
Really. So that's really the next thing I want to talk about. Just to simplify things, when people talk about, investments, I know some people think of that in the word investments as being risky, but it doesn't necessarily need to be, right? There's to make it simple, there's two real ways to invest. You can invest in equities, which is buying ownership of companies. So you can turn on CNN, BNN, whatever, and you're going to see the little tickers on the side that Apple went up, Google went up, Tesla went up or down. That is equities. You're buying shares or ownership of companies, and that's really a great growth engine. That's really, if you want to grow your money, that's where you're going to get good growth above inflation. Right? If you do want to grow your money, but grow it more conservatively and a lot slower and even safer, because those equities I was talking about, they could have bad years and things could go down as well. And especially right now, there's a lot of instability in the markets. So if you want to grow your money safely, there's things called bonds, GICs, things like that, that really, maybe their objectives to keep up with the cost of living. You're not going to get a ton more than that, but it's going to be safe, and it's just another way to invest. And those equities or fixed income or safe funds can be put in either an RSP, a tax-free or non-registered account. And it really depends on the individual, their risk tolerance, and their overall time frame and goals.
Yeah, and time frames is a big. It's probably. It's got to be one of the biggest, right?
I would think so. Yeah.
Above budget, I guess is.
Yeah, that's important as well.
Right? Yeah. Okay. So, equities, fixed incomes. I'm just trying to think if there's anything that we missed there. Is there? And it's so hard because, as I mentioned at the top of the show, you don't want to cookie cutter something, and financial futures is something you really got to take time with and speak with someone and really nail down, because everybody's situation is different. In terms of what they earn, what they want to save for, what their goals are, what their timeline is. But is there something, I guess, in terms of everything you spoke about with equities, and is there a middle of the road, like for someone out there that doesn't quite know maybe what their goals are? What would you recommend to that individual, at least to start? Because I think that's important. I said in a lot of my other videos that you don't necessarily have to have a plan, but start doing something. I don't care if it's $20, something.
Yeah, you know what, 100%, and this actually might go down. I think this is really going to help a lot of people, not just the people beginning in investing. The problem is a lot of people aren't that knowledgeable, so they depend on advisors like me to do that. And the problem is, as well, is I don't know if the stock market or financial markets are going to go up tomorrow, and I don't know if they're going to go down tomorrow, right? I just don't know that, right? And no one actually knows that. There isn't, right? But there are people called financial analysts. And those are the people that sit in front of 6 computer screens all day, analyze data, right? And that's what they do. And their job is to figure out, do we believe the markets? There's a 65% maybe the markets are going to go up tomorrow, and 35, but they don't actually know. But they're going to be more right than I am, right? So my job is to to discover what people's, or ask people what their financial goals and objectives are, their time horizon, their risk, right? Then I put their money into investment vehicles like RSPs, tax-free or non-registered accounts, whatever suits their goals the best, and give their money to financial analysts to manage it, money managers, right? And some of the best really vehicles that I like to use for clients are what we call dynamic asset allocation portfolios. And these are really good for people just starting in the business or starting saving, because what it does is it gives the financial analyst a little bit of control. If they believe the markets are going to do well over the next month, they can put you more into equities, and the equities are the things that are going to grow. And if they believe the markets aren't going to do so well, they can take you out of equities and push you more to the safe stuff. Where the average individual doesn't have the time to do that or the know-how to do that, right? So a dynamic asset allocation portfolio, I think, is great. I use it for myself, just to give you an idea, right? I would rather a financial analyst, know how many shares of Apple I should be holding, or how many shares of Google I should be holding, right? So
for those individuals out there that are fearful of the markets and leave their money in a savings account and feel it's best safe there, that was the question, is what would you say to those individuals? And you were going into, well, the fear is if I'll let you say it again.
Basically, if you don't do anything, you're gonna lose buying power because of inflation. But I think the fear for most people when it really comes to anything in life, to be honest, is I just don't think they're educated about the topic, right? So I think all my current clients can reach out and basically say, you know what, John does educate me about something, because I think that's the really most important part, is to educate people about what they're doing with their money and why they should be doing it, right? If they're educated, people make great decisions, right? So I think it's important for anybody that has money sitting in an account right now and not doing anything with it, just to get educated about things you can do with it. And there are risky things you can do, but you know what, that's not for most people. I think there's most people out there should be conservative with their money, or at least moderate. And just educate yourself, or reach out for advice and have someone educate you about it. So
and I love the example you gave, and I'm going to really oversimplify this.
Please do.
But for those that are leaving their money and just putting it in a little, under your mattress or whatever the case, take $5. I'm just going to oversimplify this because it blows my mind the price of craft dinner. And yes, I'm going there because craft dinner years ago was under $1 a box. You just, it was 50 cents at one time, and you just can't get it for that. So to your point, the loss of buying power, just to oversimplify it to that point, is listen, you can't buy the same stuff.
No, you just can't
for that money.
And you're not going to be able to, right? And there's no real right answer when the cost of life doubles. But realistically, if inflation is 3% a year, 24 years, everything's double in price. So something's $5 today, in 10 years, it's going to be, or it's going to be $10. If something's $5 today, it's going to be $10 24 years from now. But your money's not growing in the bank, right? So you need to do something with it.
Yeah. Now, let's step off now. So we kind of went over, in investment vehicles, RSPs, tax-free savings account, non-registered. We talked about, different types of equity investment, stuff like that. What about protect? Because a lot of people talk about saving for the future, but it's you really don't plan for what the future holds. So how? Because that's the other aspect of it is protecting that. You can put all your money away and take all your disposable income, put it in the future and stuff like that. But if something was to happen to a major life event or something like that, how do you protect against that?
And I want to add a few things to my agenda, because that was a great question that you had there. And you're right. There's a lot of people talk about life insurance, but that's not really what I want to go into right now. If you're working and you get injured at work and you can't work anymore, or you just get injured doing yard work and you can't make an income, how is that going to affect your household? Right? Because I know a lot of families, they have children, they have debt, mortgage, they live in a 2-income household, they need both incomes. I would say that's a majority of people, right? So if you can't make income, that's going to have a big impact on your family, right? So, but there are a lot of things out there that can help with that. If you became ill, let's say you had cancer or another illness, before you get that, it'd be great if you had critical illness insurance, right? So if you became critically ill, there's a lump sum amount of money that's given to you, and you know what? That's just going to take that financial burden and stress away from your family, allowing you to focus on your health, right? Or if you have to go away to get, medical help, you have money for that, right? Or if you became, you know, you couldn't make an income whether you were sick or injured. There's disability insurance, and I know a lot of people may have that ability to have that through their employer, but not everyone has that option.
Right.
Especially self-employed individuals, and you know, especially with COVID-19, a lot more people are self-employed. I find now,
Yep.
they're doing their own thing. So I think disability insurance, or I like to call it income replacement insurance, because your whole goal is to replace your income if you can't make an income. Right. Because your family needs it, right, to pay bills or whatever it is, right? So that's another type of insurance that, you know, if you're concerned about not being able to provide for your family, or becoming ill and not being able to provide for your family, something to really need to look into.
Yep.
Really.
Absolutely.
And then life insurance too. You know, if you happen to pass away unexpectedly, where does that leave your family? You know, is there debts that they can't afford? You know, do you have children that you're taking care of? You know, these are all things that need to be considered. And you know, there's a price associated with insurance, but it can be as cheap or as expensive if you want it to be. Right? It's all customizable, right?
Yeah.
Depending on what your needs are.
Yeah. No, it's a great point, right? Because it's I mean, well, we've already seen it. You can't plan for the future, and obviously critical illness is way up.
It's insane.
Where it was. So, you know, very important to put that protection in there, because a lot of people could just, you know, they plan so much for the future, maybe forget that aspect of it, right?
And insurance is only going up in price for two reasons. We're getting older.
Yep.
Right? As you get older, insurance goes up. There's more risk. But you know what? A lot of us we don't exercise. We don't go outside as much as we used to. Maybe we don't even eat as healthy as we used to, right? With a lot of people working from home, office jobs, we're just not getting that exercise, and because of that, our chances of becoming ill or disabled are a lot higher than they used to be.
Right.
And because of that, you know, rates are higher than they were, and they're going to continue to rise. So if this is a coverage that, you know, you think you may want to look at, this is the time to do it. It really is. Yeah.
Good. No, that's excellent. And is there a cost associated with seeking help? You know, because maybe that's on people's minds. Well, geez, I really can't afford to really get someone to come in and talk to me about this stuff. Is there a cost associated?
Yeah,
with
you know
that,
what? I guess it depends what company you're with. I know my company, we don't charge for that. We don't charge for that. If someone wants us, say, John, you know what? I wonder if you can just do an insurance analysis on me, see what we need. There's not a cost associated with that. I'm fortunate enough to represent multiple insurance companies out there. You know, the large ones: Manulife, Sun Life, Great West Life, Canada Life, and they compensate me well for doing business with them. Right. So my clients don't need to compensate me for that. Those companies do compensate us for that. Right. So just for the advice aspect of it, when it comes talking about insurance, there's no cost associated with that.
Okay.
Yeah.
Excellent, John. Well, listen, is there anything else that you had that you maybe want to talk about before we close out?
Yeah, you know, the only other major thing is, I know a lot of people out there, and this is a question I get every day. It's the only reason why I want to bring it up. A lot of people have mortgages. A lot of people, from their mortgage advisor or wherever they get their mortgage from, are recommended to buy mortgage insurance. And guess what? Having mortgage insurance is better than having no insurance.
Okay, fair enough. Yes.
But if you have mortgage insurance, please find out what a term insurance policy would cost you instead of a mortgage insurance policy. You will be surprised at the difference between what a mortgage insurance policy is in quality of product, not necessarily the price. The quality of a term insurance product can last you the rest of your life.
Right.
Where a mortgage insurance product, it's only why you have that mortgage. So you can be paying for a mortgage insurance your whole life, then you pay off your home and you no longer have insurance anymore, and that's an issue. Right. So, you know, if you have mortgage insurance today, just reach out to someone to find out what a term insurance policy would cost you. That would be my advice today, for sure.
Wonderful.
Yeah.
Okay, John. Well, listen, how can people get a hold of you if they do want to reach out and ask any questions?
You know what? I'm extremely flexible, probably like yourself. You know, I like Facebook, social media, text, email, phone calls, right? 650-5592, and look me up, Jon Duplessis, on Facebook or any other social media. So.
That sounds great. Listen, I'll leave your contact too, and I repost this on my site. I got to figure that out since we broke off halfway through, so I got 2 videos now. Anyways, I'd like to thank everybody for listening. Thank you again, and remember, live your best life. Thanks.
Thanks, bud.